We have ICICI Lombard on our list right now. As we were talking about, the general insurance and the life insurance space, we decided to invite the management to speak about the growth that they've seen. The company has actually clocked in a very strong gross direct premium income growth of 17%, but the profit growth was quite muted. In terms of different segments, it was health which contributed most of the growth, while motor remained weak this time around. We have Gopal Balachandran, the Chief Financial Officer and the Chief Risk Officer at ICICI Lombard General Insurance, who joins in. Mr. Balachandran, good morning and greetings of the season to you, your entire team at ICICI Lombard. I wanted to ask you about the private car segment because that has seen some weakness this time. And you also mentioned in your conference call that there is some pricing pressure that you're seeing in this part of the market. Can you tell us what is the outlook here on and how much could the growth be over the next fiscal or so?
Yeah, so good morning, Sonia. Season's greetings to you and to all of those at CNBC and obviously to all your viewers as well. Maybe advance wishes. And a very apt question in terms of how does one see, let's say, growth playing out, particularly, let's say, on the motor side. I think the good part is, I think, relative to the last couple of years where obviously we had seen slowdown in new vehicle sales, that seems to be kind of coming up reasonably well, particularly on the segment that you referred to. On the private car, I think definitely the demand momentum, I'm sure when you get to hear also on the channel from most of the OEMs, I think demand seems to be quite solid. I think the challenge what essentially happens is more from a pricing competitiveness standpoint. And you're right. I think at this point of time, at an industry level, particularly in the private car side, the pricing is far more aggressive. And if I were to just kind of put a data point, while we may not have industry splits across private car, two-wheeler and commercial vehicles, but if you look at the overall motor combined ratios for the industry as a whole, in Q1, that number was about 124% combined ratio. This is both loss ratios plus cost of doing business. Now, that's obviously at a significant elevated levels. And therefore, given the elevated levels of pricing that is sustaining in the market, from an ICICI Lombard standpoint, I think in line with what we have normally been doing, we are a bit cautious. And that's the reason you would have seen our overall motor growth, let's say, at close to about 14% for this half year, whereas the industry growth would have been close to, let's say, 18-19%. But that's generally our approach to, let's say, selecting risks. Whenever we see significant elevated levels of price aggression, we obviously stay invested in the distribution franchise. But obviously, so far as risk selection is concerned, we tend to get a bit cautious thereon.
Right. Gopal, hi, good morning. So just to briefly on the passenger vehicle side, one believes that you've given up some market share. Can you confirm that? Can you tell us where you're at? I'm talking about premium income. And I think on the commercial vehicle front, you've gained market share. Where are you at and what are your aspirations? Both. Go on.
No, absolutely. I think, Prashant, your point is right. I think, which is what I kind of mentioned. I think when I gave the aggregate motor numbers, our growth in the half year was about, as I said, 14%. The industry growth would have been close to about 18-19%. So to that extent, obviously, we would have underperformed insofar as overall motor is concerned. And within that, particularly in the private car segment, I think we have got far more cautious insofar as risk selection is concerned. And hence, to that extent, we would have kind of possibly let go some market share in that particular segment. However, in some of the other portfolios, when it comes to two-wheelers and commercial vehicles, we generally get to see a lot of positive ability to risk select portfolios. And particularly on the commercial vehicle segment, what we have been speaking through is to get to a mix, which in the past has been at about close to about 17-18% of our overall motor revenues have been commercial vehicles. We had said we would like to see that mix going closer to about 24-25% and not necessarily get up to the industry level of 45%, which is the industry mix for CVs. So hence, if you would have looked at the half-yearly numbers, our overall commercial vehicle mix contribution has been close to 23-24%. The growth in that segment for the half year has been almost close to about 56%. Private car would have been more or less flat. Two-wheeler, we would have kind of grown at almost about 17-18%.
All right. Hi, Gopal. Morning. Your first half, GDPI, that's gross direct premium income, that's around 23%. How sustainable is this? What's the outlook for FY23? If you could try to give us a sense out there. And you mentioned a couple of times about the combined ratio. That's around 105%. What's the outlook on that front? As well as the loss ratio? Well, for the first half, it's improved. Though on a sequential basis, it's gone up a little bit. For the year, though, what do you see the loss ratio stabilizing at? Growth, I want a combined ratio, as well as loss outlook. Go ahead.
Yeah. So I think, so if you look at, we are kind of, when we look at it from ICICI Lombard standpoint, both for quarter 1 and quarter 2, we have actually outperformed the market. In Q1, the industry growth was roughly about 22-23%. I think we are at about 24-25%. And if you look at on quarter 2, the industry growth was about 10%. We were at about 17%. So overall, for the half year, we are at about 23. The point that you made, industry growth was roughly at about 15% in terms of aggregate revenues. We are quite excited with the growth prospect that we get to see in each of the preferred segments that we can generally stay invested in, whether it is motor, whether it is health, or for the matter of fact, even the commercial lines. I think we are extremely positive on. On each of those, I think we believe there is a sustained momentum in terms of growth. Let me pick up each of those segments. Health, for example, what we have been talking through is significantly stay invested in expanding distribution, particularly on the retail health franchise. And quite happy to note that for the month of September, our growth rates, which is at about 21%, is even faster than the standalone health companies. And that's typically the kind of benchmark that we would like to largely work with. And that's an area where we are kind of significantly investing in expanding distribution. Our product expansion is also something where we have been investing a lot on the IL Take Care app. That's doing well. And hence, overall, health momentum is positive. And therefore, the growth is likely to kind of sustain as we head into second half. To your second point on combined ratios, I think at this point of time, we are at maybe at close to about 105% thereabout. What we had indicated is for the next couple of years, which is for the current year and the next year, we should see the combined ratios because we are investing in expanding distribution and franchise. The combined ratios are likely to stay around 104% or thereabout, post which we should see a declining trend of the combined ratio trajectory.
Okay.
On the last part on the health ratios front, I think it's purely a function of the way we risk select portfolio. We believe it could vary across different segments, but broadly it will stay within that range of between 70
briefly, just running out of time, so I want to squeeze in as much as possible. I think you indicated on the retail health front, you will assess if you need to take price increases. I think the last price increase was in the third quarter of 21. Have you done that? Are you going to do it?
So at this point of time, we continue to assess the portfolio experience, Prashant, and that's something that we do on a quarter-on-quarter basis. At this point of time, I think what we are getting to see is definitely there is increased levels of claim inflation on the health front. Almost a high single-digit claim inflation is what we are seeing. And therefore, we are watching the development of how the overall portfolio loss experiences are playing out. And if need be, we will take a price increase.
Okay, since we're talking about pricing, on the regulatory front, there's also this Bima Sugam, the insurance exchange that's coming through, right? Will that affect pricing in any way? Will it make it more competitive? Will there be more penetration? How do you think things will change?
Sonia, if you look at, I think fundamentally the thought process from a regulatory standpoint is to significantly embark on increasing penetration. And therefore, I think whatever the regulator is doing, they are creating all enabling environments for us to be able to do that. And clearly, Bima Sugam will be one of those channels of offering which will make it viable more from a customer standpoint. To your point on competitive intensity, I think general insurance as a sector has generally been relatively competitive. And therefore, that's likely to continue. I think it's a question of staying focused over a long term in terms of risk, which portfolio selection you want to underwrite, and corresponding discipline on underwriting.
Gopal, will it put pressure on pricing overall, do you think, Bima Sugam? Simple. Will it?
I think...
Yeah, go on.
That's the point that I'm making. I think overall, in general, irrespective of whether Bima Sugam or otherwise, this sector has generally been competitive. I think it's a question of the company's ability to stay focused on underwriting risks and stay disciplined on bottom line.
I'm sorry if we pushed you a little bit there. It's pressed on time, so I wanted to get as much. Thank you very much for joining us, Gopal. It's a pleasure, as always.